All right, team, we are back in the Fireside PM podcast, and I have an old friend from Seattle, Jason from Maveron here, and he's been doing some cool research of companies that have been successful and trying to sort of decompose what led to their success. And Jason, you were so kind to come on to the show to talk about some of your work. But before we get into that, welcome and maybe just introduce yourself to the audience.
Tom, it's good to see you again. We get to do it live after many years of not speaking. So thank you for coming out. I'm with Maveron. We're a venture capital firm focused on businesses that can transform consumer lives. What I've found over the years is so many founders can get caught in the moment that sometimes it's best especially when we're looking at a new investment, to talk about if things go right, what can happen. What would an S1 or public filing look like? What would the company look like at a big M&A event? And then you can kind of work backwards and say, what do you need to do to get there? And how do you sequence those steps? So that's an exercise I've started doing internally as we're looking at new investments. And one way to keep my mind sharp in doing it is to look at those companies that did scale successfully and analyze them and understand, how they were able to do it and why they are where they are today. So that was the backdrop on starting this blog, Ringing the Bell, where I've traditionally looked at S1s in terms of filings for IPOs. More recently, I've begun to look at private companies, largely because companies get so big before they file that I feel like there's just not enough volume of consumer-oriented companies going public to be able to write regularly, and I love to write. So I started to cover some private ones as well, and the first of those is Quince.
Nice. All right. So for those who are founders of B2C companies, consumer companies, when does Maveron typically engage with them? Like, is there a certain threshold where you want to see some traction before you talk to them, or like what's the best path there?
I mean, look, there's kind of four vectors, right? There's people, product, market, and traction. And we're typically investing, call it 2 to 8 million to lead a round that ranges from, it's hard to know what to call a round today when there's $100 million seeds, but we'll invest anywhere from a pre-seed to an A. I think the more conviction we have, either we have a thematic focus within an area or we've known a founder for a long time, the easier it is to go pre-launch or before there's data. I think when you have less of a prepared mind or you have less of a point of view on the founders, we prefer to wait a little bit and see how consumers react to the product. I mean, I think Howard Schultz, who started Maveron way back when, always used to say, I don't know how consumers are going to respond until I see them respond to it. I think that largely holds true, but there's certain founders you have to back, and you have to back before you know.
Amazing. Well, let's talk about Quince, because I don't know if a pair of founders had come to you with this idea for Quince, would you have been excited about it? Because it sounds on its face like, well, can't someone else just do something similar? And aren't there giant incumbents here? Like, how do you think you would have looked at Quince early days? Or maybe you did actually look at them.
We were conflicted out at the time due to an investment in a company called Everlane, which some of you might know. I think, what they were doing is clever, which is most people know Shein, or anyone who has anyone under 25 with Shein. And Shein was kind of working direct with factories, right? And I think Quince had the best innovations in retail come from a combination of a supply chain disruption that leads to lower prices. I mean, you see that with Costco, with their format with a membership and low margin. You see that with TJX. You saw that way back when with the first department stores and Sears, right? So you saw that with Walmart. So, I mean, what do you have here? You have Quince saying, what do factories in Asia have during certain times of the year? They have excess capacity. Those are the same factories who are making a theory shirt or an away bag. And we're going to go to those factories. We are going to say, hey, make product for us. We'll you hold the inventory. We'll guarantee that we're going to sell it. And they're selling it at price points kind of well below those name brand competitors. Super, super smart strategy. So, I mean, if you tell me what am I looking for with a bra, I think it's really hard to start a e-commerce business. I mean, it's just enormously difficult. Many try, few succeed. But if you're looking at starting a broad-based e-com business, you want to look for a supply chain disruption. And these guys had it. They cut out all the middlemen. There's no Li and Feng. There's nothing sitting between the factory and the end consumer. And they essentially copy what Shein was doing in really cheap factories and did it in better factories where brands that you and I know are making their products.
Would you have been concerned about those same factories doing deals with other companies, and now the startup is kind of beholden to a handful of these factories? Or
I mean, think about it. What you're doing is what's the rare or cornered resource? It's factory space, right? So if you kind of work under the premise that you're going to build this big enough, you can suck away a lot of the excess capacity of these factories before someone else gets to them. And there's only so many factories that make an away bag or a theory shirt. So if you could suck away a lot of their excess capacity, it's very hard to repeat. And then paired with supply chain execution has to be marketing innovation. Like, on Costco, it wasn't just super smart. It wasn't just super sharp prices. It was also having certain hero SKUs. Like, I mean, I'm sure many of you have bought a rotisserie chicken or a $2 hot dog from Costco. Everyone knows there's certain certain hero SKUs that you just can't get elsewhere. And I think Quince, their marketing hack really was the $50 cashmere sweater. Like, if you go on Quince's website, they will break down the cost basis of many, not all of their products. And they're selling $50 cashmere sweaters at a 12% gross margin. Now, anyone in retail knows that if you're selling at a 12% gross margin and it's an apparel product where there's returns, you're making no money on that. What is that? It's an alternative method of customer acquisition, right? You hook them with the cashmere sweater and you sell them everything else. So, and then you get all these influencers talking about you, and you rinse and repeat. They're selling $500 caviar for $100. They're selling, away style bags at half price. And then they move into supplements where you have a gross margin profile, and then that's typically 80%. Maybe their margin's in the mid 60s. But you go from very low margin on a cashmere sweater to a much higher margin in things like supplements or caviar or whatever it might be. And you take this from a low margin business to a really good margin business, still offering kind of screaming good prices. So, super interesting strategy to have kind of these almost loss leader price items. And I think you're pairing supply chain innovation with marketing innovation, and it's super effective.
So Bhavya in the LinkedIn live chat is saying she's on the Quince website now. She sees a yoga set for $55. I'm not familiar with those products, but I'm guessing that's pretty cheap for you. I don't know what a yoga set is, like yoga clothing, like Lululemon maybe.
They're what, like $100? They're expensive.
Yeah. Okay. Yeah. So she's like, well, how? It's probably not very good quality. It's like some Temu stuff that's not going to last. Was that part of their strategy also to like have this maximal quality? They're like the same things that are charged for twice as much, and then that kind of gets them that equivalent of the Kirkland kind of quality brand.
Look, I think about a theory shirt. They're selling it to Nordstrom. Nordstrom is then selling it to the general public, right?
Yeah.
So Theory is getting a gross margin of, their gross margin is around 60% writ large. Say for their wholesale business, it's it's lower than that because Nordstrom's taking, I don't know if it's 30% or 40% of the price. So you're cutting out Nordstrom.
Yeah.
So you're giving those margin dollars, which could be, let's say you sell Nordstrom the shirt for $75 that they then retail for 120, right? So you're taking, say, Theory, it costs them $30, $35 to make that shirt. So Theory then goes, Quince can then go and sell that Theory shirt for $75 that they're selling to Nordstrom for $75. They get a 50% gross margin because of the kind of $35 cost basis of the shirt. So you're cutting out the middleman, right? Which is your traditional distribution channel. So that's how they do it. Now, if you go deep into Reddit and you look at the comments, what's crystal clear is that most people say they cut corners. So the away bag might be constructed really, really nicely with, and the Theory bag will be constructed a little less. The Quince bag will be constructed a little less nicely. So I would say they copy the name brands. Not quite as most of the comments are it's not quite as good, but it's kind of good enough. So that's how I'd frame it.
Yeah. And is there a finite supply of factories that can do this? Like, what's to stop the Quince copycat from using the same playbook? Is it?
I mean, now you started with this loss leader. Quince has raised. Let's look at how much capital they've raised today. Quince has raised over about 400 million-ish in equity capital. Now they're producing with enough volume across multiple categories where, let's say they're acquiring a customer and the cost of acquisition is $100 ish. They started just selling apparel, right? But now they're selling luggage, whatever else it might be. So they're getting more and more share of wallet. There is absolutely no way you could launch day one with this deep of a product catalog. And do so in a way where you can generate the demand required to sell through that product. So I mean, what you have is Quince has essentially created a world where my intuition is they have what I'd call U-shaped revenue retention. What does that mean? It means you acquire a customer for $100. Let's say you acquire 10 customers. Let's say 5 just kind of try and never come back. So you have 5 customers left, after that first purchase. What U-shaped revenue retention would mean is every quarter after those 5 customers drop away, the remaining 5 customers spend more and more money with you. I mean, they have a subscription type. Like, is Nike a subscription business? Well, maybe Nike's not the best example today. Is On running a subscription business? No, but it has subscription characteristics because you just keep buying shoes, right? Every 3-4 months, you buy another pair. And then they introduce apparel, you buy that. Then they introduce, a hat or sporting equipment, you buy that. And that's what Quince has done effectively by introducing all these new categories. Is people come in, they know this is a great place to get a deal, and they just keep buying more. So how do you compete against that? Someone else has a different supply chain disruption and has a unique novel marketing strategy, rinse, repeat, and that's how you compete against it.
Do you think the tariffs or potential tariffs in the future will affect it, or is it like, well, that's going to affect everybody, so they'll be just as good as they are today?
I mean, look, tariffs are affecting everyone. Everyone is changing the constellation of where their factories are based upon what's geographically optimal from a tariff standpoint. Everyone is scrambling. Is it going to have a demonstrable effect on consumer spending? I think you're going to see a really soft holiday. Is it going to impact Quince in a way that's demonstrably more than other competitive brands? I don't think so.
Yeah. Anything else you want to share about Quince before we jump into StubHub? Because I know you looked at them as well.
I think, the interesting thing with value retail is just the sheer size of these market caps, right? So you look at TJX. How much do you think TJX is worth?
How much do I think TJX is worth?
Yeah,
I would imagine not a lot because it's like an old school retailer, right?
it's worth $157 billion.
Really?
How much do you think Burlington's worth?
The coat factory?
Yeah.
I don't know. I mean, if 157 for TJ, maybe 50 billion.
22 billion.
Yeah.
I guess where I'm going is value retail is enormous in its scale and size. Like if you can give people a deal, they will buy anything from you. I mean, Costco is, I think, what's Costco? Costco's 418 billion. So what is Quince tapping into? They're trying to be multi-category value retailer. There's just a lot of freaking market cap. So, if you were to tell me like today, if Quince is doing $1 billion in revenue this year, I don't know what the number is. Like rumors, like, is it at a 2 billion run rate? I don't know. Did it do something north of 600 last year? I know that. Yeah, that would be the case. I mean, you'd say like, would you buy at a, $3-4 billion market cap? I mean, it's hard to know without seeing the underlying data and kind of understanding the customer behavior. What I can say is, can you 10x it from there, given the size of the TAM? Yeah.
That is amazing. I, number one, did not realize those old school retailers were worth that much. And then I'm guessing Quince doesn't have this physical footprint and liability the way like Burlington does.
The thing with physical though is like there's a CAC, right? Digitally. Why does Warby Parker open stores? Because the CAC physically is going to be better than the CAC digitally. So, could Quince open a store? Sure. Like, will the unit economics of the store pan out? I think it depends on, is it more efficient for them to acquire and retain customers by maintaining it being only digital, or is it more efficient for them to be omni-channel? I don't know. Time will tell. My gut is that they're really successful. You'll see Quince stores.
Oh, amazing. Yeah. As a customer acquisition tool, not as a primary source for transacting the business.
Maybe it's primary. I mean, look, imagine you're walking through the Grove in LA, and there's a Quince store there. Like, I don't know, walk by a Zara. Like, how many people are inside a Zara or a Uniqlo? Like, could Quince merchandise a store to kind of have that kind of buzz around it? Maybe.
Yeah. Fascinating.
It's a growth lever they can pull. I don't know if they will.
Yeah. And even if they did, they probably wouldn't do giant things like Burlington and TJX. They might be smaller, almost like a showroom.
Who knows? I mean, like, this is all about like, what, I mean, I would imagine they'd play with a bunch of different footprint formats and figure out where the unit economics are best.
Yeah. That's a good reminder to challenge some assumptions. Like, I think a lot of people, myself included, would have been like, oh yeah, brick and mortar retailers, like nothing interesting there. But clearly we're seeing another generation come.
I think that's right. I mean, you're looking at your next generation of retailers, like, like, even though everyone talks about how Zara is having a hard time, Zara is worth $161 billion, right? You're looking at your next generation of retailers. Like, how many different yoga athleisure brands are at the mall now? There's like a there's Lululemon, there's this, there's that. Yeah. Like, there's a Skims store. Like, they're all opening stores for a reason. It's because there's like this golden era from 2008 till 2019-ish, and it was just so easy to acquire customers digitally in an efficient way. Now Meta and Google have figured out how to, and Amazon have figured out how to take all the profits digitally through customer acquisition. So that's why you see all these people going offline. I mean, like every nice little city in the country has like a row of Instagram stores, right?
Yeah, that's fascinating. Now, you looked at Quince as an investor. It sounds like there was some similarities with your portfolio such that you guys didn't pull the trigger?
We couldn't really.
Yeah.
I felt like we didn't feel comfortable looking at the time.
Yeah. Yeah.
I mean, in our business, you make a bet on a company, right? And then
Yeah.
you you have to be respectful in terms of not investing in. I mean, founders are entrusting you with knowledge about their business, and you don't want to invest in things that they view as competitive.
Yeah. Let's make believe you didn't have a competitive company in your portfolio. What would have been your biggest kind of heartburn looking at the Quince deal early days, or were you guys already like convinced they were going to be successful?
Their first round was from Founders Fund and 8VC in 2019. They raised 8.5. It looks like the post money was around 36 million.
Mm-hmm.
I would imagine that was prior to launch. The CEO is a Stanford MBA from 2012, and I think previously started a mall business, Lolly and Pops, which is a sweet store in Catterton. So he kind of had the right background to build this kind of business, right? I think the question really would have been like, how could he actually do what he said he wanted to do from a supply chain standpoint? Like, would the factories really give him product at really take on the inventory risk? Could he really transition from a really low gross margin, like kind of loss leader strategy with cashmere, to selling people other things? Apparel stinks as a category typically, so it wasn't really the right wedge. Those would have been the types of questions we would have been asking.
Yeah. And you can imagine, based on those questions, since they were pre-product, they probably got a lot of no's. A lot of people.
Know. I mean, he raised from Founders Fund, 8VC. He raised from a pretty high-class set of investors. I mean, it's like selling or buying a house. You only need one yes.
Yeah.
And I think if you get all yeses, it probably means it's too contrarian to be successful.
Yeah. Interesting. All right, let's talk about StubHub. I mean, they've been around for a while. What's their what do you take away from their story? Like, how do you think that came together?
I mean, they basically own resale, right?
Mm-hmm.
There's some other options, but if you want inventory and you want to buy a resale ticket, you go and buy from them. It's similar to Live Nation, right? In both cases, you're like, why did I spend $100 on a ticket and pay $30 in fees? This is criminal. The reality, though, is like, if you're buying a Taylor Swift ticket, you know it's real, so you go there. The challenge with this business is the growth went from relatively high in 2024 to relatively de minimis this year, right? The growth is, I think, 3% year over year. And they tried to go out and clearly aspired to price this thing in a way where it would reflect more faith that they can keep growing at a pace that's reasonable. I think the market doesn't believe it yet. You've seen an IPO where it came out, I think it's valued $7 billion-ish. It kind of trades a little below the IPO price. They kind of said their growth is based upon direct ticketing to a great extent. With direct ticketing, they're competing against Live Nation. That's a tough battle to fight. It looks like they're doing some stuff with the MLB. They have some international markets they're focused on, but they're not saying the resale market is growing enough where we could sustain super high growth rates just based on resale. They're saying we need to go up against this big competitor with a better balance sheet than us to justify growing at the rate we think we can grow to get the valuation we want. And it's just hard to believe it. It's kind of one of these companies where you buy it because it's trusted, but you hate them. So No one likes StubHub because, I mean, if you're trying to resell a ticket you bought, they take 20% of it.
Mm-hmm.
It just feels like they're ripping you off every which way. And but you can't argue with the financial heft of the business. I mean, it's generating 9 billion in GMV. It's generating $250 million in cash flow. It's a powerful economic story. You just wonder why they waited so long. Like, why wait until your growth is single digit year over year to go public? It feels like a
Yeah.
business should have gone out a while ago.
What lessons should founders today draw from StubHub? Are there certain things that you like that they did that you would say,
Well,
hey,
I think that there's, uh, 5 things. The first will be customers will pay for certainty even if they hate you. If you provide something they have deep, deep trust in,
yeah,
and they say they don't like you, they're not going to leave. Trust is a moat. I think second, liquidity is a moat. Like, if you have more liquidity than anyone else in a market, I mean, think about what would it take for a new competitor to come up? How do you even get the inventory? They essentially have created this two-sided marketplace, and like it's one of these marketplaces where I mean, Craigslist still generates a ton of cash flow. If like the management team fell asleep for 10 years, it will generate a ton of cash flow. So it's really hard to disrupt it. I think the other is like prioritizing cash flow. Like StubHub gets money from buyers up front and then pays the sellers later. And then float. Like, that's a beautiful business model. Like, so I think founders should look at payment terms, billing cycles, working capital, and like manage the cash mechanics. The reality is, like, if you create a cash flow cycle where you're getting the money first and delivering the product or service later, you have to raise a lot less equity capital, you get diluted a lot less. Fourth is tooling is really important. So for sellers on the marketplace, they have all this tooling around analytics, pricing, payout, and people get addicted to the tooling and it's hard for them to leave. And then I think last, it's just scale matters. Like, it just compounds. And I think the reason I'm skeptical of going into primary ticketing is they're taking the scale they have in resale, and then they're trying to compete against someone with double the scale in primary in terms of Live Nation. It's a hard additional market to go after. So look, I think this is a great business that will stay a great business. The question really is, do you value it in a way which assumes decent future growth, or do you value it in a way where you kind of say this is kind of going to grow at the rate of inflation on a year-over-year basis?
Yeah, I mean, on the direct sales stuff, I imagine their argument is like, well, we have so many people coming here for the resale tickets that we might as well offer them the direct sales stuff too. For the tickets.
How do you get access to the direct tickets without the relationship with the venue, which Ticketmaster owns? So that's where it falls down, right? Like, can you go to small venues that Live Nation doesn't have a proprietary relationship with? Sure. Do you want to go up against them? I mean, if you're competing with them, like, who the winner is going to be the venue. You're not getting any economic profit from that. So that's the challenge.
Yeah. So in terms of the tooling, if they didn't have any of those tools, they still have enough critical mass where that's where the liquidity is. So sellers would still go there, wouldn't they? Or do you think the tooling actually is a difference maker?
It's a lot easier to stomach their take rate if you think that their pricing engine enables you to get more revenue. So, I mean, all this stuff works in concert, right? Like, I don't think the moat consists largely of liquidity, but the tooling doesn't hurt.
Yeah. Yeah, it's like to use your real estate analogy, you may pay a realtor a fee, but if she or they help you sell for a higher price, it might be fine.
They always claim they do. Do they really? Yeah.
I love it. Well, Jason, it's been great catching up with you through these case studies. I'm a sucker for a good case study, so I appreciate you doing two with us. I want to remind people that if they like this stuff, they can go to your Substack, ringingthebell.substack.com. How often are you gonna do these every week, or what's the?
I mean, I've been doing this for a few years, largely with the cadence of S1s.
Okay.
I will do them either when there's an S1 or when I'm inspired. So it could be 3 times in a month. It could be nothing for a quarter. It just really, I'd encourage people to sign up. There's a huge archive. We can see where I was right and where I was wrong if you go back on these.
Yeah.
I mean, there's a lot of companies in there where it either worked or didn't work. Turo never went out, for example. You keep going down, and there's been some successes and there's been some successes and some failures. I mean, you have like Grow Collaborative, which was deeply unsuccessful, went the wrong way. Olaplex.
These are
You
great.
have others that have been phenomenal. So what's pretty clear is that I talked to a public markets investor once who said your job is to figure out if they can get to $1 billion in value in the public markets. My job is to figure out if they could 10x from there. And I think what I've come to realize by writing these is most companies can't.
Yeah, that the IPO is kind of the
not a finish line. If you view it as a finish line, then you're finished, right?
but many can't get much past that. That's often their high point. Which one do you think you got wrong the most? Which one was the one where you're like, oh man, I was way off on that one?
It's a good question. I haven't gone back and deeply thought about it. Reddit might be one.
What was your where'd you get it wrong with them?
I had no idea that LLMs would use their data in a way.
Oh, that's true.
It would lead to becoming a incredibly important training mechanism for those models.
Yeah. That's like buying Alaska and finding gold later.
Exactly. So, I mean, if you look at, I was very skeptical because Reddit was like this weird social network no one used. Right?
Yeah.
Until it wasn't. Now, every time you do a search, like the SEO results pop up Reddit. So now the thing's worth, 43 billion, which is up. I mean, the stock's at 232. I think the IPO was at 49. I was dead wrong. I said sit on the sidelines.
Yeah. Well, that was hard to see.
Yep.
So is your Substack the best way for people to stay on top of what you're talking about? Or
just, look, we're investing, Mavron's investing across 5 areas. One's future of retail, which is both retail brands and the infrastructure of retail brands need to be successful, which is changing dramatically with AI. Second bucket's frontiers in wellness. I would say anything that doesn't or barely touches the insurance system that's related to living better, longer, with more vitality. Third is workforce empowerment, everything from labor marketplaces to benefits to prosumer tools. Fourth area we call money matters, which is personal finance and home ownership. And fifth is future of play, anything from NIL, consumer social, gaming, etc. So I think for any entrepreneurs who have big ideas in those areas, just shoot me an email at jason@mavron.com.
Love it. Thank you so much, Jason.
Thanks, Tom. Talk to you soon.
Look forward to it. Take care, buddy. Bye. All right. That was awesome. I felt like we were back in B school. So some takeaways from my conversation with him just now. Before I do that, let me just remind you that I have a Future of PM survey that is, if you fill it out, you can get the full results early, and you'll get invited to a private readout from me and discussion with some other product leads. So I'm going to put that in the live chat if you're watching this live, and I'll put it in the description as well after. So fill that out. Okay. And then stay tuned when I share the results. They're actually, I've already started taking a look at some of them. They're kind of surprising. So it's pretty cool. I asked like, hey, what do you think are the key skills PMs will need in the kind of AI world? And do you think PMs PM orgs are going to grow or shrink, or what's going to happen to new career PMs versus established PMs? What tools do you prefer to use? All that kind of stuff. So stay tuned for those results. And if you want to fill in the survey, it only takes a few minutes, and you'll get the results first and then invited to the VIP kind of readout. Okay, takeaways from the talk with Jason. I think on the Quince one, it's always these, it seems to be that always there's the big startup winners are the ones where you kind of scratch your head initially, and they just don't quite make sense on first glance. Like if I had come to you and I said, hey, I want to start a company, I'm going to get some deals with factories, and I'm going to sell like cashmere sweaters at a loss, but then I'm going to make it up by selling other products at a gain, but at less margin than at lower prices than retail, because I'm going to cut out the middleman. I think many investors would say, like, I get logically how that could work. How are you actually going to finagle these factories to do it? Are they going to do a good enough job? And how are you going to get it into people's hands in a reliable way from, when you don't have any of this infrastructure? And kudos to the early investors who are like, yes, let's do it. So I think from an investment point of view, like the big winners are the ones who obviously get in when it's not obvious. So kudos to them. And then on the StubHub one, I thought that was a really interesting marketplace discussion around, scale being its own moat, which has some kind of echoes of land grab days back in previous kind of tech booms. But you see how StubHub has maintained and still exists and is thriving and profitable. Are they going to be able to grow from there? Maybe, maybe not, but at least they have kind of unlimited runway in some ways. And they have a very valuable customer base that's coming to them for resale tickets. So maybe that's where I might disagree a little bit with Jason around, well, if they want to do the first party ticket sales, yeah, they're not going to start with the big stadiums, but they might start with the smaller venues that Live Nation doesn't even talk to or doesn't want to support, and kind of eat their way up. Who knows? Let me know in the comments what you all think. And hopefully if you found this conversation useful, can you do me a solid and like and share, because we all serve at the pleasure of the algorithm. All right, team. Hopefully this was helpful. And if you want to get future write-ups of these interviews, go to the Fireside PM Substack. It's free, and you'll get a readout and summary as well as the embedded video. Bye, team. See ya.